Welcome to my channel. I'm Scott, and in this video I am going to walk you through the process of valuing Vodafone stock by analyzing their financial statements and dissecting their financial ratios so we can determine if it's a buy or sell. Vodafone is a telecommunications company mainly operating in Europe and Africa. It does operate in North America and other locations through its partners. The company is headquartered in the UK and was founded in 1982. It started trading in 1988 and can be found on the Nasdaq, London Stock Exchange, Mexican Bolsa, Deutsche Börse, Xetra, Vienna, Swiss, Buenos Aires, and Bulgaria Stock Exchange. It is the largest mobile operator in Europe. It has 315 million customers around the world, 28 million broadband users, and 22 million TV customers. 150 million euros have been donated to this company in response to the COVID-19 crisis. It saved 12.4 billion euros on taxes in 2020 due to its strong relationships with each country's government and its ties to the local communities. 4G is available to 98 million people in Europe and 62 million in Africa. 5G is only available in 12 European countries, which is up from 8 in 2020. Even though 5G technology is available, there will still be many countries whose technology is not able to take advantage of it. Just something to consider when investing in a company like this that has many customers in developing countries. The company said its June 30th, 2021 quarterly revenue rebounded from the hit caused by the coronavirus pandemic last year, and also it's on track to meet its expectations for the full year. It also said service revenue, which is a key metric for the telecom sector, returned to growth in Europe and continued its positive trend in Africa. Both its consumer and business-facing segments contributed to the rise. Revenue for the quarter was 11.1 billion euros compared to 10.5 billion for the same period last year. Whether people work from home or in the office, they will need Vodafone service. Same thing whether the population is traveling or staying home, it will always need communication services to keep in touch with family and friends. Let's get started with the model. This is a large cap company, 45 billion market cap. They're trading at $16 a share, and they have 2.8 billion shares outstanding. Let's look at their financials. The way you value a company is you estimate the free cash flows into the future, and then you discount those numbers back to today's value. That's what we're doing in this video. And free cash flow is cash flow from operations minus capital expenditures. So you can see they had a ton of free cash flow in 2020, $11.6 billion. It did come down to $10 billion in 2021, but that's still a lot more than 2018 and 19. Net income is the profit or loss on the income statement. It's revenue minus expenses. And that's all over the place, positive in 2018 and 2021, a big negative in 2019 and 20. Revenue is the sales for the company, and that has been decreasing from 55 billion down to 52 billion. This is the company's income statement. All their financials are in euros. I converted these numbers to US dollars on my Excel spreadsheet. The top line is the revenue, the sales. Below that is the cost of revenue. These are the expenses directly related to generating the revenue. Revenue minus cost of revenue gives you your gross profit. And that's pretty consistent, around 13.5 billion to 14 billion euros a year. Below that is operating expenses, and then below that is operating income. And their operating income peaked in 2020 at almost 9 billion. It did drop to 5.5 billion in 2021, but that's still more than 2018 and 19. They do have a lot of debt, so they have 2.6 billion euros of interest payments on their debt, but they can cover that more than 2 times with their operating income. And the bottom line of the income statement is their net income, which looks a little wonky because of all the other items below operating income. So they only had 100 million euros of net income in 2021, a big negative in 2019 and 20. They had these big negatives from asset impairments. So when I look at the income statement, I focus on operating income, not net income. This is the company's statement of cash flows. The top line is operating cash flow. That's how much cash the company generates from its operational business. So you can see they generate a lot of cash flow, over 17 billion euros. You could think of operating cash flow as net income converted to cash, because net income is your accounting profit or loss. It's not actual cash. And they do spend a lot on CapEx, around 7 to 8 billion euros a year. In order for people to get phone or internet connection, they need to build infrastructure in a lot of different communities. Operating cash flow minus CapEx gives you your free cash flow. And they do have a lot of free cash flow remaining, so they do pay a nice dividend, almost 7%. They paid down 6 billion euros of debt in 2020, and 8 billion in 2021. Since they had so much cash flow remaining, they also buy back a lot of stock. They bought back 1.8 billion in 2018, half a billion in 2019, and 800 million in 2020. When a company buys back stock, that decreases the shares outstanding, making your shares more valuable. The reason they generated $17 billion of cash flow from their operational business and had such a small amount in net income was because they have so much in depreciation expenses. They passed through over 14 billion euros of depreciation expense in 2021. So that brings down their net income $14 billion, but it's a non-cash item. It doesn't affect cash flow. Their capex is around $8 billion. Since their depreciation is so much higher than capex, that may indicate they just spent a lot in capex in prior years. That's why they have so much depreciation. And just last week, the company announced they're launching a buyback program over the next 8 months. So since their free cash flow is exceeding their $5 billion target, they have a lot of excess funds to buy back stock. That's a really good sign. If you look at the equity section of their balance sheet, it looks like they raised $151 billion from selling stock, and they lost $122 billion from running their business. That is a big red flag, but since they're buying back so much stock, I think a lot of the stock buybacks are reducing their retained earnings. So that's why they may have negative retained earnings. And also when you pay a dividend, that reduces retained earnings. It may not be as bad as it appears. I did try to look through their financials to get more information on this negative $122 billion of retained earnings. I had a hard time finding the source, which kind of makes sense because retained earnings is your historical profit or loss since you started your business. Let's look at the capital structure. 66 billion of equity, 79 billion of debt. They have 46% equity, 54% debt, and their net debt is $67 billion. Their weighted average cost of capital is 8.28%, and that's a discount rate we're going to apply to the future cash flows. We estimated 4 years of future free cash flows. We also estimated a terminal value, which is all cash flows past year 4, that's $154 billion. We discounted those numbers back to today using the weighted average cost of capital. We get a value of the company of $149 billion. We divide that by 2.8 billion shares. And we get a calculated stock price of $54. They're trading at $16, so they're trading at a 70% discount. It's a strong buy according to the model. So just because I say a stock is undervalued doesn't mean I'm going to buy the stock. And I have bought stocks that I felt were overvalued just because I think they were great companies. The discounted cash flow model is just one tool you'll use to figure out whether you want to buy or not buy a stock. Simply Wall Street values the company at $53 a share. They're also saying it's undervalued. One analyst priced this stock and their price target was $27. It looks like the stock peaked at about $70 a share. And from the peak, it's down 80% to where it is today. So for the past 10-15 years, the stock hasn't performed well at all. The stock is up a little the past 52 weeks, but it looks like it came up a lot higher, close to $20 a share, and then it's down about 20% from that point. A lot of people invest in this company for the dividend. They pay a really nice dividend, 6.7%, and they pay a semi-annual dividend payment, 53 cents in December and 55 cents in June. They pay out 30% of their free cash flow, so they have 70% left to pay down debt or to buy back stock. Their industry pays a really good dividend of 5.8%, but they're even higher than their industry at 6.6%. The stock has a pretty low beta, so it's not too volatile. The stock is up 7% in the past 52 weeks, while the S&P 500 is up 33%. The 52-week low was 13, the high was 20, and the stock is trading below its 50-day and 200-day moving average. About 4 million shares are traded each day on this stock. All the shares outstanding are on float. 9% are held by institutions. 0.5% of the shares are shorted. If you include dividends, this stock is down the past 3 years and 5 years, while its industry is up a lot. Analysts are projecting their earnings to grow 30%, which is less than their industry, and they are projecting their revenue to grow 2%, also less than its industry. In the past 5 years, their annual earnings increased 30%. If you invested $10,000 into this company 10 years ago and reinvested the dividends, you'd be at about $10,000 today. BlackRock is the biggest shareholder at 8%, then Vanguard, HSBC, UBS, and Norges Bank. Let's look at their financial ratios. They have a really bad PE because their net income is so low. They have a great price to sales ratio. It's below 1. So that means their revenue is higher than their market cap. It's nice to invest in a company with a really good price to sales ratio, but it's even better to invest in a company with a good price to earnings ratio. And they have a really good price to book ratio, but most of their equity is intangible assets. But their tangible book value per share is pretty poor because they have a ton of intangible assets on their balance sheet. They have a pretty low return on invested capital. They have a good interest coverage ratio above 2, a really low ROE, and they have a good current ratio and quick ratio. They have 10 billion euros of cash on their balance sheet and about 5 billion of restricted cash. Restricted cash is cash that's set aside for a specific purpose. So they do seem to have enough capital to fund their operations. They generated over $10 billion of free cash flow in 2021. They have negative $500 million in working capital, and they spend over $3 billion in dividend payments. So they have $6.5 billion of excess funding. The best way to look at ratios to compare them to companies in the same industry, I've done videos of 14 companies in the same industry as Vodafone, and if VOD has a number in red, they're worse than the average. If they have a number in blue, they're better than the average. So they have a really bad price to earnings ratio. Their price to sales and price to book are a lot better than average. They're pretty close to average in current ratio. They don't have a good ROE. They are a little higher than average in debt. And they're a pretty big company, but they're still below average because there's some really big companies in this industry. And they pay a great dividend, almost the highest, close to 7%. So to summarize, I have them trading at a 70% discount, but I think the reason the stock isn't higher is because people are concerned about how much debt they have. And that does concern me as well. If interest rates go up a lot, they may have difficulty refinancing their debt, or the interest payments on their debt will get so high that they won't have any money left over to pay a dividend or run their business. But they have over 300 million customers, so when a company is this big, sometimes they're too big to fail. They may get support by their government or by the companies they work with. Because if somebody lent $1 billion to this company, they don't want to see them go bankrupt because then they may lose their $1 billion. They want to see them continue paying the interest payments, even if they have to renegotiate the terms. Because that's really the worst situation for most people, is when a company goes bankrupt. Because it hurts the company, it hurts their employees, it hurts their creditors. In the long run, it's probably better, but in the short run, it does hurt a lot of people. I rank their free cash flow 7 out of 10, their revenue 7 out of 10, and their ratios 5 out of 10. So let me know what you think. Give this video a like, subscribe, or comment below. Also, if you'd like to get a custom valuation or just support the channel, you can become a member by clicking on the link in the description below. Thanks for watching.